There's a quote in this book that Howard gives you from John Kenneth Galbraith talking about how little finance or access to capital or financial markets as you know it, how little it plays as people talk about history and what occurred in history. You know, over the years, and there it comes. Why don't you tell us about that to start, Howard?
Well, first of all, it's from a book called The Brief History of Financial Euphoria, which I read a very long time ago, which I recommend to everyone. It gives you a good feeling for cyclicality, for the behavior of the herd, for the importance of contrarianism. And it is an honest book in the sense that it is brief, and I enjoy that. But the point is that in investing in particular, one of the outstanding characteristics is shortness of memory. And the point is we know so much from history, but if we disregard history, we know so little. If we disregard history, then every time something happens anew, we have to start from scratch figuring out what it means. If we understand history, we can put it in a, we can do what I call in the book pattern recognition. And we can say, oh yeah, that's like, that, I saw that 10 years ago and 30 years ago, and here's what it comes from, and here's what plays out, and here's what it's going to result in. But most people ignore history. Most booms, and I've probably lived through about half a dozen real booms in my 50 years in the business, are usually about something new. And the internet in '99, the Nifty 50, Xerox in '69, whatever it might be, subprime mortgage securities. And the people who get excited about it, who cotton to it, who are intoxicated by the positives and willing to ignore the negatives, if you say to them, well, that happened 20 and 40 years ago and it ended badly, what they say is they use the 4 worst words in the world. It's different this time. The rules of the past don't apply. Yes, the average PE ratio historically has been 16, but now it's 32, and that's okay because the internet has changed the world, and something like that. And so, go back one slide though, if you will, and what it says is that past experience, to the extent that it is part of memory at all, is dismissed as the primitive refuge of those who do not have the insight to appreciate the wonders of the present. And if you say to somebody in '99 who's buying an internet stock which has no profits and no sales and at an astronomical price, they say, well, you just don't get it. You're an old fogey. And the point is that the past is relevant, and now you can bring up that next slide, Michael, because that was a good one. Thank you. And most of the time it's not different. Now clearly some of the time it is different, but not as often as people think.
Let's talk for a moment about this slide by Reinhardt. And there was a book written this time, it's different, and it really related to sovereign debt and credit. And so I'm at Berkeley in '65 studying credit, and almost all sovereign debt is rated AAA. And it's considered the least risky debt of all. And the head of the Federal Reserve, Paul Volcker, in the '70s, is telling everyone that no country ever defaulted, ever went bankrupt. Yet it has absolutely nothing to do with history. And I think I want to just underline this point that Howard has made here. When you step back in history, ask yourself, have you done the original research? What is common wisdom? As I listened to Paul Volcker in that period of time, Chairman Volcker, talk, and the speech I remember most, Howard, was one in around 80 or 81, that Poland is not International Harvester. Both Poland and International Harvester were trading at 31 cents on the dollar. And his point was, Poland is a country countries don't default or don't go bankrupt. And of course, International Harvester could go bankrupt. Well, he was right, but he was wrong. International Harvester paid you off 100 cents on the dollar, never missed an interest payment, and Poland reorganized its debt in the 30s. So for every dollar of debt, you got 30 cents of
Well,
something.
he was right semantically, he was just not right financially, right?